Good morning, traders. My name is Gaurang from BCR, and I'll be bringing you with the latest insights and key levels from the markets. The instruments we'll be looking at today are dollar index, spot gold, Australian dollar, and crude oil. Let's dive right in. The dollar index is under significant pressure, hovering around 103.95 after experiencing a sharp decline last week. The dollar has fallen for 5 consecutive days, reaching its lowest level since early November at 103.56. This drop follows Federal Reserve Chairman Jerome Powell's comments, reassuring markets that there is no immediate need for policy changes, despite growing economic uncertainty. The Nasdaq also suffered substantial losses, falling 3.3% as investors awaited key US inflation data. The dollar's decline has been exacerbated by concerns over President Trump's trade policies potentially slowing economic activity. The dollar index experienced its worst weekly performance since November 2022, falling 3.5%. It is struggling to recover above the 104 level with technical indicators like the death cross, a bearish pattern, and an oversold RSI suggesting continued downside risks. If the dollar index fails to reclaim 104, the next support levels are at 103.56, followed by 103.34, 103.38, and potentially 103. On the upside, key resistance levels include 103.99, 104, 1, and 104.40, though the bearish momentum remains dominant for now. Gold prices started the week with a 0.70% decline, dropping below $2,900 amid rising US recession fears and uncertainty over US President Trump's trade policies. The highest intraday level reached $2,918 before selling pressure pushed prices down. However, global uncertainty provided support, with gold rebounding toward $2,915 in the early Asian session. Trump's recent trade moves exempting Canada and Mexico from tariffs under USMCA while maintaining a 25% tariff on steel and aluminum imports created market uncertainty. This policy stance could drive safe haven demand, potentially supporting gold in the short term. Despite a brief pullback due to a stronger US dollar, gold remains above its 30-day moving average of $2,882, maintaining a medium-term bullish outlook. The technical indicators suggest the next resistance levels are $2,930, followed by the record high of $2,956. A breakout above $2,956 could push prices towards $3,000. Conversely, a drop below $2,900 could bring the 30-day moving average at $2,882 into play, with a further downside support at $2,856. The relative strength index indicates further upside potential, keeping gold prices in a consolidation phase with bullish momentum intact. AUD/USD declined by 0.4% on Monday as risk aversion weighed on the pair. Initial support came from concerns over US economic slowdown, but weak Chinese inflation data and ongoing trade tensions pushed the Australian dollar lower. President Trump's mention of a transition period added further uncertainty to the US outlook, while China's unexpected drop in a consumer price index signaled weakening demand, increasing downside risks of AUD/USD. Despite last week's stronger than expected Australian GDP and trade data, rising global trade tensions have kept risk appetite subdued. The Reserve Bank of Australia maintained a cautious stance on further rate cuts, indicating that February's cut does not signal ongoing easing. Technically, AUD/USD briefly traded over 0.63300 before falling back with a 9-day moving average at 0.6278, suggesting weakening short-term momentum. The four, the 14-day relative index remains below 50, reinforcing a bearish outlook. Key resistance levels are at the 100-day moving average, 0.6362, 0.6400, and the 3-month high of 0.6409. Immediate support lies at 0.6274, with a break below with this level, potentially triggering further declines towards 0.6234, 0.6200, and last week's low of 0.6187. Oil prices declined on Monday, March 10, as concerns grew that US tariffs on Canada, Mexico, and China would slow the global economy and weaken energy demand. Additionally, OPEC's decision to increase production put further downward pressure on crude prices. While crude initially rose during early European trading, it remained near 3-year lows as market sentiment remained weak. Crude briefly touched $65, marking its lowest level in 3 years. The Energy Information Administration (EIA) reported an expected increase in US crude oil inventories, adding to bearish sentiment. OPEC's first production increase since 2022 exacerbated supply side pressure. However, demand side risks remain a more significant concern, as higher oil supply may struggle to find sufficient buyers. Crude has fallen for 7 consecutive weeks, the longest losing streak since November 2023. Technically, crude remains in a downtrend, with the 14-day relative strength index near oversold levels. The MACD suggests weakening bearish momentum, but a reversal signal is still absent. Key support levels lie at $65, $64.75, and $64.31, while resistance levels are at $67.5, $67.77, 9-day moving average, and $68.89, 14-day moving average. Further declines could push prices towards $62.34, the November 2021 low. That's all, traders. That rounds up today's market analysis. Thanks for tuning in. Don't forget to like, comment, share, and subscribe. Also, if you have any further questions, then don't hesitate to leave a comment below, and I'd be happy to answer. Good luck with your trades.